When you sit down to finalize a $450,000 real estate transaction, you are usually hit with an avalanche of paperwork. Between the lender fees, the legal documents, and the escrow accounts, the sheer volume of math can be completely overwhelming. We are going to systematically decode these calculations. We will walk step by step through how to accurately calculate broker commissions, daily interest rates, and property tax prorations for a standard home sale. This is the HUD-1 settlement statement. To make sense of the math, we will sort all those complex calculations into two distinct columns on this form. Section J on the left represents the buyer, and Section K on the right represents the seller. Mastering the layout of this document takes a chaotic pile of transaction data and organizes it into a balanced, legally verified financial agreement. Step 1 is to plot out the core, static numbers of our transaction before we apply any complex fees. Our baseline facts are simple. The parties agreed to a $450,000 sale price. The buyer has already put down a $70,000 earnest money deposit, and they are bringing a new $380,000 mortgage loan to the table. The $450,000 sale price is our starting point, recorded on line 101 for the buyer and line 401 for the seller. Next, we log the buyer's inputs, the $70,000 deposit on line 201 and the $380,000 loan on line 202. By establishing these baseline credits and debits first, we create a clear mathematical anchor. Every fee we calculate from here on out will simply add to or subtract from these starting values. Now we can calculate the seller's liabilities, starting with the broker's commission. The sellers agreed to pay 6%. We multiply the $450,000 final sale price by 0.06, resulting in a $27,000 charge. On page 2, we map the calculated commission to line 703 in the seller's right-hand column. We then record the remaining static seller fees, $900 for title insurance, a $1,500 attorney fee, $25 for the deed, $324 in transfer stamps, and a $550 survey charge. Before the seller can collect their profits, they also must pay off their original mortgage. Because closing is on May 10th, they owe their $184,000 base balance, plus exactly 10 days of accrued May interest, which amounts to $197.74. We take that final combined loan payoff figure of $184,197.74 and map it back onto the primary summary page. It is recorded on line 504. Once all liabilities are charted, it is clear how much of the seller's home equity is consumed by the transaction's overhead. Switching to the buyer's side, the lender charges a 1% origination fee and 1.5 points. These percentages are based strictly on the $380,000 loan amount, giving us $3,800 for origination and $5,700 for the points. Returning to the settlement sheet, we record these loan procurement charges on lines 801 and 802. This time, they are placed in the buyer's column on the left. Next, we handle prepaid interest. Because the closing date is May 10th, the buyer is required to prepay 21 days of interest at their daily rate of $57.26 to finish out the month. That gives us a total prepaid interest charge of $1,202.46, which is mapped directly onto line 901. The lender also requires the buyer to fund an escrow reserve account up front. For this transaction, the buyer must prepay 8 months of real estate taxes and 4 months of hazard insurance. We log the reserves, placing $800 for insurance on line 1002 and $1,714.67 for taxes on 1004. Then we log static buyer fees. Notably, appraisal and credit reports on lines 804 and 805 are marked POC, paid outside closing, excluding them from the final totals. Completing this buyer's ledger exposes the true hidden cost of borrowing required to finalize a mortgage. Now we reach property tax proration. This is frequently the most common failure point for confusion over who owes money to whom. The current year's taxes aren't billed yet, but the seller occupied the home for 130 days before handing over keys. When the county issues the annual tax bill, the new buyer will be forced to pay it in full. To make this fair, we use the 365-day method. We take the annual $2,572 tax burden and divide it by 365 to get a daily rate of $7.05. We multiply that daily rate by the 130 days of seller occupation, resulting in $916.50. To compensate the buyer, we map this $916.50 as a direct credit on line 211. To fund it, we map the exact same amount as a direct charge to the seller on line 511. Strict prorations ensure that neither party pays for a single day of tax overhead while they didn't actually own the property. With all the complex variables calculated and charted, our final step is to bring it all to the bottom line. We transfer the sum totals of all those individual charges from page 2 directly back to the summary sections on page 1. To find the buyer's final number, we take their gross amount due on line 120 and subtract the loans and deposits they brought to the table on line 220. The result on line 303 reveals the final amount the buyer must wire to closing. We do the same for the seller. We take their gross sale proceeds on line 420 and subtract their mortgage payoffs and settlement fees on line 520. The result on line 603 reveals the exact final payout they will receive. The HUD-1 successfully distills a tangled web of fees, prorations, and escrows into two definitive, legally binding numbers that make the real estate transaction possible. Pause the video here and check your own practice sheet against the final calculations on the screen.